Investing in growth stocks. Everything you need to know about growth stocks. If you want to secure your future with handsome and life-changing earnings, then investing in growth stocks is the best way. You've heard many times about the term growth stocks when it comes to investment. This video will give you an idea of what is growth stock, how to invest in growth stock, and how you will get a benefit when you invest in growth stocks. So let's get started and watch the video till the end to get the detailed knowledge. First, we'll learn what exactly growth stocks are. Growth stocks are the shares in the companies that expect to grow at a rate remarkably above the average growth for the market. These stocks usually do not pay any interest or dividends. When investors invest in growth stocks, they expect to earn money through capital gains in the future when they sell their shares. It means that a growth stock grows at a faster rate than the average stock in the market and consequently generates earnings more rapidly. Now let's talk about the characteristics of growth stocks. Number 1. High growth rate. As their name suggests, growth stocks tend to show a significantly higher growth rate than the average market growth rate. It implies that the stocks grow at a faster pace than the average stock in the market. Number 2. Low or zero dividends. Growth stocks usually pay either low dividends or zero dividends at all. It's because growth companies are growing at a very fast pace and hence typically want to reinvest their retained earnings back into the company to boost the revenue generating capacity of the business. Number 3. Competitive advantage. Growth companies usually demonstrate a significantly higher growth rate because they tend to possess some kind of competitive advantage over other companies in the same industry. The competitive advantage gives growth companies a unique selling proposition, USP, which helps them sell and grow better than other companies in the same industry. Number 4. Loyal consumer base. Since growth companies enjoy a competitive advantage over other companies within the industry, they tend to enjoy a loyal, growing consumer base. The USP that such companies enjoy over their competitors ensures a constantly growing consumer base, which contributes to their increasing growth rate. Number 5. Revenue. Since growth stocks pay either very low or zero dividends, investors don't make much out of their investments in the short term. However, the long-term outlook is completely different. Investors can generate substantial revenues through capital gains after seeing growth companies experience twofold, threefold, or multifold growth over the years. Number 6. Risk factor. Investments always come with some amount of risk. Such a fact is also not foreign to growth stocks. While growth stocks are a very attractive investment option and can generate substantial profits in the long term, the level of uncertainty surrounding them in the short term contributes to a high risk factor. Such uncertainty arises from the fact that growth stocks usually pay low or no dividends. Hence, the investor only profits from the investment in the long term, provided the company performs well. In the rare case that a company fails to perform, the investor may incur losses. Hence, like every investment, there is a risk factor attached to growth stocks. Number 7. Higher earnings per share and price to earnings ratio. Related to the increase of its stock price, the typical growth company also enjoys a high earnings per share growth rate. Basically, this means that its profits are growing faster than the market average, which is ultimately what leads investors to push up its stock price. For example, Tesla has an eye-watering price to earnings ratio of 1,444, while the Nasdaq Composite and S&P 500, Standard & Poor's 500, average out at around 40. Its higher price is due mostly to an expectation that it will deliver higher future growth. How do you know if a stock is a growth or value? Instead of looking to future growth potential, value stocks are those that are thought to trade below what they're really worth and will thus theoretically provide a superior return as their stock prices catch up with fundamentals. Unlike growth stocks, which typically don't pay dividends, value stocks often have higher than average dividend yields. Value stocks also tend to have strong fundamentals with comparably low price to book ratios and low price to earnings values, the opposite of growth stocks. How to find growth stocks? To find great growth stocks, you'll need to identify powerful long-term market trends and the company's best position to profit from them. Narrow your list to businesses with strong competitive advantages, and further narrow your list to companies with large addressable markets. Growth stocks can be found in any field, but most are in innovation-prone industries. Many growth stocks can now be found in the tech sector. This is hardly surprising, given that the tech sector is the most disruptive industry operating today, producing companies that that are innovating with new products and business models. What are the examples of growth stocks? Number 1. Amazon. Amazon is considered one of the best performing successful growth stocks over the years, as one can tell from the giant online retailer's immense and continuing success over the years. Number 2. Facebook. Facebook is another growth company that's been extremely successful over several years. While once the most popular growth stock, Facebook suffered its own set of setbacks in recent years relating to data privacy issues, violation of privacy rights, and other issues. Despite the numerous challenges, Facebook remains one of the most successful growth stocks with an ever-increasing growth rate. Number 3. Apple. Apple is another one of the most sought-after growth stocks over the years. Apple's been able to achieve a continuous increasing growth rate at a very fast pace, primarily because of a very brand-loyal consumer base. The company oversees a brand that consumers want to affiliate themselves with, not just a product, but the brand altogether. In addition, unique and high-quality products and constant innovation give Apple a competitive edge over its competitors. Number 4. Netflix. Netflix joins our list of profitable growth stocks. Just like the aforementioned growth companies, the online streaming giant started small but operated well in gaining a loyal, growing consumer base and providing streaming services. Since the company was the first one to offer such services, it enjoyed a competitive edge over other market participants, helped by an already established loyal consumer base. Hence, Netflix was able to grow as significantly as it did. What are the downsides of growth stocks? Unfortunately, high risk is another characteristic shared by growth stocks. The leading disadvantages include economic. Growth stocks are sensitive to business cycles. They perform particularly well during boom periods and decline more sharply during busts. There was a dramatic demonstration of this tendency during the bursting of the dot-com bubble in 2000 and the ensuing 2001 recession. That said, the era of the 2020 to 21 coronavirus pandemic seems to have bucked this trend somewhat, at least with tech or digital-based growth stocks. They're performing well despite the underlying stagnation of the economy overall. Expensive. It's easy for all the buzz to make a growth stock overvalued by the market. Susanna Streeter said, "Some companies and sectors can get hyped up by investors who drive their share prices to unjustifiable heights." Volatile. Growth stocks have historically exhibited more volatility than other stocks, rising and falling in price more frequently. For example, Amazon's beta value, a measure of how much it moves relative to the stock market, is 1.20, while Apple's is 1.28. The market overall scores 1.0. This indicates that these stocks experience price swings more often than the overall market, exposing their holders to more potential losses as well as gains. That's all for today. Also, we'd like to mention that this is not a channel intended to provide specific financial advice, and we do not ask you to invest in any company. This is merely a channel directed towards bringing educational content to your doorstep. With that in mind, before you invest in anything, we recommend you do thorough, wide-spectrum research on the topic. We hope you liked this video. Let us know what you think in the comments section below, and make sure to subscribe and give us a thumbs up. See you next time at the EdPreneur. Goodbye!